Well, good afternoon. On behalf of Dorsey and Whitney and our panelists today, I want to welcome you to our seminar on the SEC's recently adopted CEO pay ratio rules. Thanks for attending today, both here in Minneapolis and in many locations across the country through our webinar. For those of you attending here in Minneapolis, please be sure to sign the green sheet for CLE credit. For those of you attending the webinar, please, materials were sent out this morning, which include a sign-in as well as the program materials. Webinar participants may submit questions before or during the program by emailing dorseyu@dorsey.com, and we will respond to you after the program by email. My name is Gary Tygeson, and I will be moderating the panel today. I am partner here in Dorsey's Minneapolis office, where I advise publicly held companies on corporate governance and securities law issues, as well as transactional matters. To my immediate left is Jason Brenkert, a partner in our Dorsey Denver office, a member of our Canadian cross-border practice group, and co-chair of Dorsey's firm-wide capital markets and corporate compliance group. Jason's practice focuses on advising public companies on securities law and corporate governance issues, as well as domestic and cross-border transactions. To Jason's left is Cam Wong, Senior Counsel and Assistant Corporate Secretary for General Mills, where she has, among her many other responsibilities, a lead role in the annual proxy and annual meeting process. Before joining General Mills 10 years ago, Cam was an associate here in Dorsey's corporate group, where she received excellent training.
I agree.
Cam is very active in the Society of Corporate Secretaries and Governance Professionals, and she also serves on the boards of Mill City Credit Union and the Minneapolis Community and Technical College Foundation. And I might add, Cam will be a future contestant on Jeopardy! So in the Q&A period at the end of our presentation today, Cam will be stating her answers in the form of a question.
This is my dry run, by the way.
We are fortunate to have Cam with us today and look forward to hearing her point of view from the perspective of an in-house lawyer who actually has to deal with these issues, as well as a seasoned governance professional. To Cam's left is Whitney Holmes, also a partner in Dorsey's Denver office and a member of our firm's capital markets and corporate compliance group. Whitney has a diverse practice across various industries, including national and international transactions, and he regularly advises S&P 500 companies on SEC compliance matters. Jason and Whitney authored our email update on this topic, which is part of your materials today. So, the CEO pay ratio rules are finally final. More than 5 years after they were mandated by Congress as part of Dodd-Frank, nearly 2 years after the SEC issued its proposed rules, following a record number of comment letters, almost 300,000, nearly all form letters in support of the rule, the final rules were issued by the SEC in an open meeting on August 5th, published in the Federal Register Tuesday, and become effective October 19th. To say the least, these rules have been a lightning rod for commentary across corporate America, and now they're here and we need to deal with them. So what do you need to know now? We will start by giving you a 20,000-foot view today of what changed from the proposed rules that were issued in September of 2013. We will then drill down into the details of compliance, taking into account these changes. And we will wind up our discussion with, again, a bigger picture view of some of the consequences, what to expect both internally and externally as a result of these rules. We'll have Q&A at the end if time permits, but those of you here in Minneapolis are invited to ask questions along the way and chime in as we go. So, what's new? First, the final rule pushes out the initial compliance date by a year. Initial disclosure is now required following the reporting company's first full fiscal year beginning on or after January 1st, 2017, which means for most reporting companies, pay ratio disclosure rules will first appear in the 2018 proxy statement. I see this as a big break for reporting companies who will now have the remainder of 2015, all of 2016, and a good chunk of 2017 to really figure this out, hone it, before they have to report it in 2018. The new rules also give companies flexibility to determine the median employee only once every 3 years. Just a caveat here, the new determination is required if the employee population or employee compensation arrangements change and the company reasonably believes the change would result in a significant change in its pay ratio disclosure. So this could be an issue for a company that has a big RIF or a restructuring. Companies also have the flexibility to select another employee with substantially similar compensation position if the median employee's comp changes in a way that the company believes would result in significant change in the pay ratio, or the median employee is no longer employed. So you don't have to go through the same drill all over again. You can just pick the next person in line. The issue of which employees should be included in the computation has been a very big hot button. The SEC did not give very much here. They read the act literally, employees mean employees, and Congress meant employees. So they did provide a limited relief for companies in 2 circumstances. If the compliance rules for determination of the median employee would violate data privacy laws of the foreign jurisdiction in which the non-US employees are located. There are hoops here, and we'll discuss those hoops in a minute. There's also a DeMinimis exclusion for non-US employees consisting of up to 5% of the reporting company's total employees, net of whoever you are excluding because of the data privacy rules. The new rules also permit use of cost of living adjustments, which can help smooth out some of the data, particularly the issues raised by OUS employees. Companies only need to include employees of consolidated subsidiaries. Companies now have the flexibility to select any date within 3 months prior to the last day of the last completed fiscal year, rather than having to use the last day of the fiscal year. And companies also have the flexibility of using alternative pay ratios and disclosure in addition to the required ratio and disclosures. The proposed rules did not specifically prohibit or permit this, and the SEC, I think, gave us all a big window here by expressly saying this is permitted. We will all be taking advantage of that. There's a new exemption for employees of acquired businesses in the year of acquisition, and there are some limited group exemptions for new reporting companies, smaller and emerging growth companies, foreign private issuers, and investment companies. These issuers are also allowed a transition period following registration or the loss of the exemption before being required to make the pay ratio disclosures. That's it from a 20,000-foot level. Cam, before diving into the details, I know you've been anticipating these rules for quite a while at General Mills, probably hoping they would never be adopted. Were there any big surprises from your point of view in terms of the new rules when you saw them?
Sure. So just a little bit of context. We submitted a comment letter to the SEC on these rules back in December of 2013. And we were really surprised to see the volume of comments that came in after that. I don't know if people kept track, but it looks like they received well over 280,000 comment letters. And about 99% of those were form comment letters in support of the rule. And, you know, at the time, we weren't looking to challenge the merits of the rule. We left that to Congress and the courts, and we're still hoping against hope that something will develop there. Our objective was really to make suggestions that would help us produce a more informative ratio and produce it in a way that's cost-effective and easy for companies. And so, you know, we recognize the SEC was in a difficult position, and I feel like the final rule gives companies more flexibility for sure than what the proposed rules do. And, you know, for example, I love the fact that under the final rule, we only have to determine the median employee once every 3 years. Not loving the caveat. You know, I think personally about our company situation, and we've had a couple of reorganizations over recent years, and I'm thinking, wow, you know, if we have another one, that means, you know, I'll be in a position where I'm going to have to determine the median employee annually, potentially. Not only that, but I might have to decide whether or not that person's still going to be around in a year, let alone whether I'm going to be around in a year. And that, frankly, sounds cruel and unusual, so I'm not loving that. You know, there were a couple of other things on our wish list, so it almost felt like, you know, writing to Santa and seeing if we would get a big chunk of coal back. And we didn't. You know, I would have loved it if the rule had been limited to full-time employees. And I don't think that would have hurt the benefits of the ratio, but we didn't get that. We were really pushing for the ratio to be furnished rather than filed. And I think that there are a lot of good reasons for that. You know, you encourage more fulsome disclosure. You don't have the pressure of your CEO and CFO having to certify to that, but the SEC was not convinced there. So, you know, those were a few of the disappointments.
Thanks,
but,
Cam.
Overall, you know, more flexibility for sure.
Yeah, thanks, Cam. So like everything we do as lawyers, the devil's in the detail, so let's get into some of the details. Jason?
Thanks, Gary. So now we're going to move on. As Gary said, we're going to go into a little bit more of how this has actually been implemented and how you're going to have to comply. So, and as we're going through this, again, feel free if there's a question you want to ask to ask your question, and we can answer it at the time. But here it is. Here's the new rule, the new item on Regulation SK. It's pretty straightforward in its form. You know, you have to disclose the median of the annual total compensation of all employees of the reporting issuer, except for its PEO, and then you have to disclose the annual total compensation of your PEO, which you already do in your summary compensation table. And then C here is the ratio and how it's going to be expressed, which is basically, you know, counting A as 1 and then either counting it as a multiple at how many times it goes into B, or expressing it as a ratio of 1 to B, so 1 to 150, 1 to 200, whatever that happens to be. So it's pretty straightforward from the item, but of course, how you get to that disclosure is going to be the difficult part for many companies. So to start out, when must the pay ratio disclosure be put into your reports? As Gary mentioned, they pushed this out, and so it's not required until the report for the first full fiscal year that is starting on or after January 1st, 2017. So that does mean for most of our calendar year reporting companies that this won't be required until you file your proxy statement for your 2018 meeting of your shareholders. And then, as you'll note, in any event, the disclosure must be made within 120 days of the end of the fiscal year. This is basically, you know, just a reminder of your Form 10K. You're incorporating your Part 3 information by reference, as the instructions to that form indicate. If for some reason you fail to file that the definitive proxy statement within 120 days, you will have to file a 10K-A to include your Part 3 information, which will include this pay ratio disclosure now. So the special case, So the special cases, we went through this at the beginning, so I'll just cover it again here briefly. New reporting companies, smaller reporting companies, emerging growth companies, foreign private issuers have a transition period following either the registration or the loss of exempt status. For those companies that are smaller reporting, emerging growth, or foreign private issuers, it's going to be a 1-year transition period. So you'll lose your status at the end of one fiscal year. You'll get an entire fiscal year there where you will, in order to comply with the report that's filed and the year after that. So you get pretty much a full fiscal year to comply. After you lose your exempt status, for newly reporting companies, you know, it's in your next annual report after you've registered. So that period might vary a little bit, but again, it's probably going to be looking at almost a full fiscal year until the new reporting companies are going to have to comply as well. Where must it be disclosed? Registration statements, proxy and information statements, and annual reports. Only if the form currently applies or as it is amended in the future, it requires your 402 executive compensation disclosure. So there was some push on this in the comment letters where people wanted to require this disclosure in pretty much every filing that you made with the SEC. Thankfully, the SEC did not go that route. They said, no, it's only relevant in executive compensation disclosure, and so it's only going to be required in the forms that currently require that. Now, note for registration statements and annual reports, for many of you, it's not actually going to be there. It's going to be incorporated by reference because you're filing probably an S3 that incorporates your filings by reference for registration statement, and your annual report's going to incorporate your proxy statement. So most likely for most issuers, this is going to be only in your proxy statement. So let's get down into how we're actually going to do this calculation in order to determine the ratio. Most of the work obviously is in what has been called the denominator, because it's the denominator of this ratio. The numerator is pretty straightforward. It's the PEO annual compensation that you've been doing for years in your summary compensation table. So all of the focus is on the denominator. So as Gary mentioned at the beginning, the SEC did not give any ground on what needs to be included in there outside of a few limited exceptions. So it does include all employees. So that's all U.S. and non-U.S. employees. That's all full-time, part-time, temporary, and seasonal employees. So there were a few qualifications. So for permanent, full, and part-time employees, you are allowed to annualize their compensation. So if you have someone who is a permanent full-time employee who joined halfway through the year, you can take their comp and you can annualize that. Same for a part-time employee who is permanent. You cannot do that, however, for temporary and seasonal employees, only for permanent, full, and part-time. The other thing that the SEC did not give any ground on was your ability to do a full-time equivalent adjustment. So no full-time equivalent adjustments are allowed for any type of an employee, whether they're part-time, temporary, or seasonal. The other development that did come in with the final rules was that you only have to include employees of the company itself or any companies that are consolidated, any subsidiaries that are consolidated with the company when it prepares its financial statements. And that was at least useful in that it gives some clarity as to what companies that you have control over actually have to be included in this calculation and looking at their employees. So it's not that if you have 20% control of another company that suddenly becomes a company that maybe you have some indices of control that you then have to look at their employees. It's only if it gets consolidated now in your financial statements, which in most instances will be 50% or greater controlled subsidiaries. And then the final point on all employees here is that employees of unaffiliated third parties, and we put in quotation marks, maybe independent contractors would not be included. The point on independent contractors, however, was qualified in the adopting release in saying that the compensation must actually be determined by an independent third party. So if the independent contractor is employed by another company, that pretty much solves the issue. But if it's an individual or maybe a freelancer that you're hiring and you're saying that they're an independent contractor, there could be some question as to whether or not they are. I just asked Cam how you guys are dealing with that issue in determining independent contractors.
Yeah, it goes without saying we would have preferred a looser definition of independent contractor, so we're going to be taking a look to see if there's any material impact in terms of, solo practitioners, freelancers that we're hiring. I do think it's going to be more of an issue for certain business models than others.
Thank you. So there were, in the adopting release, some limited exclusions that were allowed for non-U.S. employees, and they were very limited. So there's two of them, really. The first one we see here is that you're allowed to exclude non-U.S. employees if they are in a jurisdiction where the privacy laws would essentially prevent you from getting the information you need in order to conduct this calculation. So you can't ask your payroll provider or whoever has the information on payment of these employees to provide you this information without violating privacy law. This is a very limited exclusion, however, because of the efforts that must be put in order to rely upon it. The company has to use all reasonable efforts to obtain the information, and that includes seeking any possible exemptions from the applicability of the data privacy laws. And obviously, It's not clear at this point how far reasonable efforts have to take you and how often you're going to have to appeal in foreign bureaucracies to get exempt from their privacy laws before you can say that you're done. And the second part is then you'll have to also get foreign legal counsel to issue a legal opinion saying that you've done everything you can that's reasonable. So I don't know what the practicality of actually following this is, and we'll have to see as it gets implemented and companies start looking at specific jurisdictions and can they get an exemption or not. And there will also obviously be some coordination issues there because you don't want to be the company saying, hey, it's not possible, when all of a sudden all of your peers have gotten an exemption and can do it. So I know, Cam, if you guys have been looking at this and how useful this exemption might be for General Mills.
Yeah, I mean, I just can't help but think that there are going to be a lot of companies out there looking for the same types of information in the same types of major jurisdictions if they have international operations. And so, for sure, you know, we are each legally required to get our own analysis and our opinion, but we want to stay coordinated potentially through professional organizations, because you don't want to be the company that says, oh, yeah, we couldn't get information out of Germany and all of your peers were able to.
Yeah, that'll be interesting to see how this one develops and if it's actually useful.
Or even vice versa. You don't want to be the company that gets information out of Germany and all of your peers say it was illegal.
That's
that
right.
Too.
Yeah, for sure.
So the second exemption here, exclusion that is permitted, is the DeMinimis exemption. And that's for up to 5% of your total employees who are non-U.S. employees. I'll just make one note on what this is. This is 5% of total employees. The adopting press release with the summary and some of the language that's in the adopting release itself makes it a little bit confusing in how they state it, which is this 5% of total employees who are non-U.S. employees. And at certain points, they just say 5% of non-U.S. employees. But it is 5% of total employees, not 5% of non-U.S. But obviously, you're excluding non-U.S. employees. So what is this? There's 2 points here. You can exclude all of your non-U.S. employees if it's under 5%. So if you're looking at non-U.S. employees being 5% or less of your total employee base, then you can just exclude them all and not worry about it. If you have more than 5% of your total employees that are non-U.S. employees, then you can go up to the 5% limit. So how does this look in application? So it can be a little bit confusing as it's just laid out. So here's an example that comes right from the adopting release. A company has non-U.S. employees located in 2 foreign jurisdictions. One of the jurisdictions has 2.5% of the company's total employees and has data privacy laws that result in the company excluding all non-U.S. employees in that jurisdiction. And the other jurisdiction has an additional 2.5%. So basically what you're going to be able to do is you'll exclude all of the data privacy employees, so that gets you 2.5%. And then you can exclude all of the employees in the second jurisdiction, and that gets you up to 5%. Now, if the second jurisdiction had over 2.5%, then when you add that with the data privacy exclusion, you'd be over 5%. Which means that you could not exclude them because you cannot pick and choose a certain number of employees in a jurisdiction. So it's all or nothing on a jurisdictional basis. So each jurisdiction you have to look at. If it's under 5%, then you can say, okay, we might be able to exclude them. What does our data privacy exclusion look like? If you have none, then you can exclude that jurisdiction, and you can keep adding jurisdictions up until you reach that 5% threshold. But if any one jurisdiction, or if any jurisdiction when you add it puts you over, then you can't exclude anybody in that jurisdiction. So it's an all or nothing for each jurisdiction.
So if you had 3% in Germany and 3% in Denmark, not relying on the data privacy exemption, you could exclude the 3% in Germany or the 3% in Denmark, but you could not exclude the other country. So you're kind of
You couldn't
stuck.
do both, yeah. And you couldn't do like, oh, let's do 3% in Germany and 2% in Denmark. You know, so. The last exception, if you will, it's kind of a temporary exception, is that employees of a business combination or acquisition are excluded in the first fiscal year of that transaction. So if you just acquired someone or you just merged with someone, you can exclude those employees in that first fiscal year, but you are required to disclose what transaction that was and how many employees are being omitted. So it gives you some transition time there to get those people into your payroll system and figure out how you're going to handle them.
Right.
You only have to do it every 3 years. So you exclude because it was an acquisition, but then the next year will you be forced to recalculate with them in, or can you still use the median for the next 3 years?
That will be a question that you'll have to determine as to whether or not the addition of those employees have such a significant effect on the likelihood of your median annual employee compensation that you need to recalculate. Because remember, it's every 3 years only if you're comfortable that there hasn't been a significant change. So if those employees that had come in are de minimis and they don't constitute a significant portion of your workforce, you might be able to get comfortable that, yeah, we can just continue with our current median employee. But if it is significant, then you will have to include them and recalculate that year. Good question.
Right. And it's important to bear in mind the change, it's not the significance of the change, it's basically an estimation of whether the change would have a significant impact on the pay ratio.
Yes.
So you might even have a merger of equals, but if you get comfortable that the pay scales and distribution were similar enough between the two companies, even though it doubled the size, it might not be a significant change in the pay ratio disclosure. This is one of the areas where I see that river of no action letters coming down. So.
Which will probably not be answered.
Yeah, SEC, well, we're not going to offer
right away.
an opinion on that. All right, so the biggest part in this calculation is determining who the median employee is. That's going to be the most difficult part of implementing this rule. Once you figure out your median employee, and you have to do that once every 3 years, assuming there's no significant changes, then it's pretty simple. You calculate their annual compensation on the same basis as you do the PEOs on the summary compensation table. Do the division, and you've got your ratio. So this is really where implementing this rule it becomes most difficult, and this is kind of the meat of this regulation right here. So when are you going to determine your median employee? As we just mentioned in our discussion, that's done at once every 3 years unless there has been a change in your employee population or employee compensation that you reasonably would result in a significant change to your pay ratio disclosure. And then the other determination date, so that's how often do you have to do the determination. The actual determination date itself, you get to pick a day, any day within the last 3 months of your last completed fiscal year. So you can be somewhat strategic, I guess, and if there is a strategic day within those 3 months in which to select people. So there is some flexibility there that the SEC has granted you from the proposed rules. But you select that day, and that's the day that you're going to determine who are your employees. And then you're going to get all the compensation information on those employees, and that's how you're going to determine your median. So how do you do that? To identify the median employee, the rule allows companies to select a methodology based on their own facts and circumstances. And this is really a good grant by the SEC to allow companies the flexibility to actually implement this rule. And it also is very important because it permits companies to structure the methodology that is unique to their circumstances and thereby justify why their ratios are different than other companies. And later on in our presentation, Whitney will be discussing that and some of the considerations of implementation and the consequences as to how you structure your methodology and how you present it is going to be very important in how you argue and how you respond to people who note that your ratio might be much higher than your peers or is much different than your peers. You can go into, hey, our methodology is different. That's why we got a different ratio. And, our circumstances are different, and it's reflected in our methodology. And you don't have to use your total employee population in calculating this. You can use statistical sampling of that population or, quote unquote, other reasonable methods. There's been a lot of discussion as to what that is. Most people can't think of it, either you're using the total population or you're using some sort of a sampling of that in order to do a statistical analysis. So I don't know what other reasonable methods might necessarily be. but if you can come up with something, perhaps some sort of an estimate of certain populations, then you can do that as well.
And that's an area where I think we're going to be hearing a lot from compensation consultants and the Aon Hewitts of the world in terms of different methodologies and how they can assist you in running those samples.
Mm-hmm.
And I think also that, bear in mind, the distribution of compensation throughout an organization. Cam, as you were mentioning earlier, whether you have a bell curve or dumbbell curve, or you may be, weighted towards one end or another, depending on whether you're high tech or manufacturing or heavy manufacturing or what. So each company and each industry is going to have a different distribution, and the kind of sampling you use will be affected by that distribution. So you almost need to know the answer before you can come up with the great question.
Yeah, it's a little bit of a chicken or egg first issue, right? So you need to gather some very basic information and understand the distribution of pay across your employee population before you can decide whether statistical sampling is really going to be useful to you. One initial thought that we've had is we do have pay banding, at least for our salaried employees. So the bands of pay that include, base and incentive, and they do go across jurisdictions. And so is there an opportunity to dust those off and use them in conjunction with sampling to make this an easier process?
So when we talk about determining the median employee compensation, you can either use the definition of annual total compensation in the summary compensation table that you use for your PEO. That probably is going to prove to be very burdensome as you apply it to your entire employee population. So unless you have a very small employee force, you're probably not going to want to do that. The rule does allow you to use any consistently applied compensation measure. And it doesn't really describe what that has to be, so the companies are free to decide what their consistently applied compensation measure is going to be. But there obviously can be some substantial issues in making that determination. It can be tricky because whether you use a payroll or maybe your tax records in order to capture compensation, those records obviously are not going to capture all of the compensation that might be relevant to the median calculation. So if you're using just the cash payroll, it might not capture pension plan differences and 401k vestings. And so you might find that you have similarly cash compensated employees, but one's much older and has been at the company for a longer time, and they have a higher vested in their pension. So when you move to the 402 summary calculation table, summary compensation table, and you have to include those pension benefits, all of a sudden, similarly situated employees have vastly different compensation. Same thing for taxable income, and this could be a jurisdictional difference. If you look at taxable income in some jurisdictions, they exclude employer contributions for health care and Social Security type payments. And in other jurisdictions, health care and Social Security are actually taxed as part of your taxable income. So that can result in drastically different compensation measures for your employees from jurisdiction to a jurisdiction. So these are all things that you're going to have to consider in determining what exactly are we going to say is our consistently applied compensation measure. I don't know, Cam, if you guys have thought about what your consistently applied compensation measure is going to look like.
Yes, I mean, I think we've started exploring that, and it is a headache, to your point. So seemingly straightforward measures, like what if we were to consider all cash compensation across jurisdictions? As we take a deeper look, actually not so comparable across jurisdictions, because you think about cash and what it can be used as a proxy for. Is it a proxy for medical benefits, education benefits, housing, and so you rapidly realize, oh, wait, there's more in it. And if we were to rely on all cash compensation year over year, is it somehow more volatile than using a measure like just base salary? So we've definitely started thinking about that.
Here we see that when you're determining your annual compensation, the SEC has granted a cost of living adjustment now. The way that this is actually applied is that you can do a cost of living adjustment for a jurisdiction that is not the jurisdiction in which the principal executive officer resides. So if you have employees that are non-U.S. employees and your CEO is living in the U.S., you can do cost of living adjustments from those jurisdictions to the U.S. If you do a cost of living adjustment for a jurisdiction, for an employee in a jurisdiction, you must apply that same cost of living adjustment to all such employees in the jurisdiction. So you can't just pick and choose a class of employees in a jurisdiction to do the cost of living adjustment to. And then you must use the same cost of living adjustment in calculating the median employee's annual total compensation at the end. So if you have particular jurisdictions that you've done a cost of living adjustment in, once you determine the median employee, you're then going to have to use that same cost of living adjustment when you're determining their summary compensation table calculation for your ratio. And then you must also disclose the median employee's annual total compensation and pay ratio without making this adjustment. So in other words, if you're using cost of living adjustments, once you select your median employee, you're going to run their 402 compensation calculation, and then you're going to have to do a cost of living adjustment for that to do the ratio disclosure, but then you're also going to have to disclose what it would have been if you hadn't have done that. So there's some additional work there, and you'll end up having two ratios that you have to disclose if you do these cost of living adjustments. But depending on where your employee base is, it might be very useful to make these adjustments.
This is really complicated. It seems to cry out for somebody that's gifted in computer programming or a group of them to come up with a software program that can run all these different variables based on the data you plug in.
Yeah.
I
And the
agree.
scary thing is, I mean, these ratios are being left to people like me who have no experience in that. And,
Yeah.
you know, it makes you wonder who in their right mind would actually rely on this ratio other than plaintiffs' attorneys and the media, which is also scary.
Indeed. And then the fact that you have lawyers talking about statistics is very scary as well.
Yes, yes.
So some implementation points. Cam, do you want to talk through these for us?
Yeah, sure. So, you know, we've talked through a few of them already. Obviously, I mean, I think I'm not shy to say we will be testing alternative methodologies. We'll be using historical data to test them to see what type of compensation measures work out best. And, you know, I think taking a step back, what, you know, our objective would be is to produce a ratio that we can explain year over year in the context of our compensation program. And so to be more specific, at least with our program, I think a lot of other programs, the more senior you are in the organization, the more of your compensation is incentive-based. And so in a good performance year, that ratio should be larger than in a poor performance year. So that's just some food for thought as we're testing through. We're definitely involving our financial reporting group in our discussions because, hey, you know, they already have systems to gather information that can be tested for internal controls that our executives can certify to. So is there an opportunity to build out those existing systems to capture the type of payroll data that you're going to need to calculate this ratio and actually have your CEO certified to it? You know, it goes without saying, we're looking at the impact of contract and seasonal employees. So exactly when are those seasonal employees being hired and how does that relate to the calculation date? Exploring cost of living adjustments, and then I think we did talk briefly about privacy concerns and the importance of coordinating, you know, with other companies on the approach to that.
Yeah, those are all good considerations. And that kind of leads us into our next one is, you know, are you going to end up using sampling or not? You can see some of the considerations. Obviously, the size of your employee population will be a determining factor. Because if you don't have a lot of employees, then there's no real need to take a sample. You might be able to just do this directly on the total population. But the other thing to consider is, you know, what does your compensation structure look like as it varies and how is it distributed over your employee population? Because that will determine, you know, how much the sampling makes sense and what kind of sampling you want to do. If you have a fairly uniform looking employee compensation structure, you might be able to do a random sampling that would save you money. but it's less reliable and less accurate. So you're probably going to end up doing some sort of a stratified sampling where you use, as Cam had mentioned, you probably have some sort of a banding structure in your payment, in your employees' payments, or you have an a fixed employment structure where you have specific employee roles that you can probably do a sampling in each of those specified employee structures, and then use those samplings out of the stratified structure to then do your compensation analysis. And then the other consideration is how big of a sample size do you need to take when you're doing the sampling? You know, how big is enough to make a reasonable sample size? Is it just the square root of your total employee population, which is a typical industry marker for a good sample size, or does it need to be bigger? So these are all concerns that go into determining, is sampling going to be right for your company? Cam, do you have some thoughts on sampling?
I agree with all of that. More data is needed on the distribution of pay across our employee base before we can decide whether it's useful or not.
Yeah.
I think both the utility and the methodology are going to be very company specific, and it's going to vary between industries. It'll vary depending on companies that have a large international component versus companies that might not have as large an the age of the company is going to affect if you do sampling and whether or not you can do something. It's going to be something that's very driven by the unique characteristics of each company's business.
And then finally, who needs to be involved in the process? Obviously, you're going to have the employees that are responsible for gathering the data and conducting the sampling. So this is probably going to be human resources, perhaps your financial reporting teams, and your legal team. Management obviously is going to have to be involved because they're going to have to certify this as part of the disclosure. And then your compensation committee is going to be interested in what this is going to look like because it's going to affect the CEO compensation and retention. And then your board is going to be interested in the ratio disclosure because of the broader effects this might have on the company. So Cam, I assume General Mills has a dedicated team at this point?
We do, and really we're just trying to play catch up with our board of directors. I mean, there are a number of directors who are very interested in the pay ratio rule, and they're already asking us for calculations, and we kind of have to put it in perspective for them and say, you know, it's a process, and you know, keep the objectives in mind. You know, we want something we can explain year over year, and we want to stay sensitive to what our peer companies are going to be doing.
Do you have kind of a cross-departmental group on your team, Cam? Who do you draw in? Who's helpful in this?
Yeah, so the usual suspects, compensation is obviously really involved, especially our payroll system, because they're actually in a project right now to consolidate all of our payroll systems around the world. Financial reporting, legal, obviously. And then as we get closer, you know, we're going to rely on information systems to really make sure that where we house this data is secure and that we're collecting data efficiently and accurately. And then, as people have mentioned, obviously the compensation committee is overseeing all of this along with our executive. So it's kind of a balance about, you know, when and how much we want to share with them as we progress.
Is it too early to tell who's going to be driving this bus? Is it going to be legal or comp or some combination?
Well, you know, there haven't been a lot of volunteers stepping forward. I would say right now I've, you know, by default am the quarterback, but this is not going to get done without cross-functional support in the company and for sure external expertise, outside counsel, compensation consultants, and yeah, we might be needing a statistician in there somewhere.
And talking about outside reliance, how are you going to be dealing with your vendors, your payroll vendors? And they're probably the ones that are going to give you this information. You're going to have to make those requests. And it might be outside the scope of your current contract with them.
Yeah, so I mean, that's a good point. It's something we're going to have to examine the contractual relationships and, you know, make sure that we receive the information in the most cost-effective way possible. And, you know, in our particular situation, we are consolidating, and so there are going to be other negotiations too besides information gathering, as in, hey, you know, I'm sorry, this contract might be up next term. Mm-hmm.
Yeah, it might force some companies to consolidate their payroll systems, just to simplify this process.
Yeah, and, you know, just to be clear, we're not doing it just for the pay ratio, because that's the cart before the horse. I mean, I think there are a lot of audit, financial reporting, and HR reasons for consolidating as well.
So this is just to kind of wrap all of that up. You are going to have to describe in detail the methodology that you adopt and the estimates that you use. And so you're going to have to think about how you're going to describe exactly what you're doing and how you're going to justify it as a reasonable process, because you're going to have to detail it in your disclosure. But this can also be of benefit, as Whitney is going to discuss in our next section here, because it might allow you kind of a narrative in which you can discuss your ratio and why it's different than your peers. So I think the last point on this, in this section is just that additional disclosure is permitted, so you can do additional ratios if you're feeling like the one ratio is not enough for you and you want to do a bunch more, then you can do as many as you want, as long as they're clearly identified and not misleading and not presented with a greater prominence. So with that, we've got one slide for the New York.
If you're in New York, please wake up. This is very important information coming your way. The secret code for New York CLE participants, your verification code, is about to be announced. So stop multitasking, get your pens ready. It is ZTZ798. That's Z as in zebra, T as in Thomas, Z as in zebra, 798. So I want to ask Whitney, having gone through this drill and all the details, what do you think we should be thinking about in terms of consequences? What should we be expecting in terms of kind of internal and external reactions to this in terms of preparing? There's a whole lot more to this than just crunching the numbers. What do you see in your crystal ball?
Well, actually, that's a great segue, because to that point, as Jason just mentioned, if you put additional ratios or information in your disclosure, you're not allowed to have it be misleading. Since I've been looking at this for over 2 years, I still haven't quite figured out what pay ratio disclosure is supposed to be telling people. I'm not entirely sure how it can either mislead them or avoid misleading them with anything else I say. So bear that in mind. The SEC was very clear in the adopting release, and I made the point several times that the pay ratio disclosure rule as adopted is not intended for comparison amongst companies or between industries. We all know that's going to happen. But I think what the SEC was trying to signal to issuers was that they should, in the SEC's view, focus on the company-specific metrics, the company-specific decisions, and the company-specific output of the process in the mathematics, and stay away from trying to make something that's comparable across companies. And I think that's very important for a lot of reasons. First of all, because I think it's true. I look at different clients, and none of them have the same profile that will lead to anything approaching the same kind of ratio. And it doesn't mean anything anyway. I try not to confuse people's compensation with their worth. Unfortunately, that seems to be the idea behind a lot of the press coverage. You know, why is your CEO making this many times what your average worker makes? Well, there could be a whole bunch of reasons for that, and those reasons are going to be different in different companies. So it's really not comparable amongst companies, and the SEC gave issuers the latitude. In fact, it was almost like they were instructing us to focus on that and to be very specific about why this ratio, you know, it is created with the data for this company and the specifics around it. Nevertheless, of course, there will be comparisons, and some of those comparisons will lead to you know, difficulties in the press or publicity and so forth. There's also going to be controversy associated with this. Let's advance the next slide. Continue to be controversy associated with this rule. So while it's uncertain that there won't be challenges, in fact, I should say it's certain there will be challenges. There are existing challenges in Congress. A couple of bills to repeal 953B have been submitted, but there's also opposition to that, and it's unclear to me whether in the current election cycle where we are there will be any action before pay ratio disclosure starts to appear in proxy statements and other filings. So I think repeal's uncertain in Congress and probably unlikely. There's also been some talk about challenging the rule in court. We saw successful challenges to proxy access and more recently to part of the conflict minerals rule. And so there's been discussion about whether or not litigation will be raised. I think the Chamber of Commerce has not yet said anything. They've been successful in a couple of cases. That said, I think the SEC has learned from proxy access and from conflict minerals and has built a record in the final rule, in the rulemaking process, that will survive at least the specific criticisms of the judges in those cases. And so whether or not somebody can come up with a new novel litigation strategy is an open question. And again, this was mandated by Dodd-Frank, which has been pretty resilient so far in the courts. So I think that a judicial repeal is uncertain and probably unlikely. So I think we've got to really seriously face this rule and think about its impacts and making the disclosure work. That, to me, makes me think about what it is that this is aimed at, and what are the potential consequences. A lot of discussion about stockholders and shareholders wanting this information, but there are other constituencies that I think will be affected, and companies' responses to those effects are going to be important. So there are some of the possible consequences. Some are obvious and some are not quite so obvious. For many companies, there will be a high number, and those companies will need to think in advance about how they want to address the potential effects of that in the press, amongst their employee populations, and others. The existing press reports, there's also an education component inside the company to think about, because the existing press reports that I see tend to focus on the S&P 500 and data that's available for pay ratios in those specific companies. Now, those tend to be large companies with big employee bases. Some of them are very mature, so they have well-established but highly distributed pay bases versus brand new companies that might have more concentrated pay bands that they're dealing with. But the result of looking at the S&P 500 is that those numbers tend to be much higher than they are when you look at broader populations of companies. So there's a fair amount of statistical research out there about what happens when you look at 3,000 or 5,000 companies in the Wilshire Index versus the S&P 500, and those ratios come down dramatically. You see numbers more in the ranges of 30s and 40s and 50s to 1 as opposed to 200 or 500 or 800 to 1. So understanding the data and what's out there and what becomes available through the rule from both management and also internal communications to employees is going to be very important to avoid the misunderstandings that I think the press tends to generate by picking dramatic numbers to try and, I guess we used to sell newspapers, now we sell clicks or capture clicks or whatever we do. But that's the natural goal for the press, is to try and capture attention. So they're going to use numbers that are, or they're going to try and focus on numbers that are somehow dramatic. And companies will need to be in a position to explain why there's not so much drama there. Another group that's going to be affected is, or potentially affected in various ways, is employees and employee-related issues. Obviously, this becomes an emotional case. It tends to be founded on this idea of equity somehow, and whether some people should make a lot more than other people. As a result, a company with a high pay ratio number, as Cam pointed out, that might be because performance has been really good, which helps the whole company. At the same time, that may affect morale in a negative way. And so companies, I think, internally need to address and think about that. It could affect hiring and retention, and in different ways. Again, most of these things have a tendency to cut two ways. Some people might be attracted to a company with a high ratio, and other people might be repelled. So you might not even see potential hires, if that number's out there and not well explained. You don't have the opportunity, if you don't take the opportunity to explain your number. Obviously, organized labor and large institutional investors have been proponents of this number. What they will do with them when they actually have them available remains to be seen, and will be driven in part by how good the disclosure is and how well the companies engage with those constituencies as these numbers start to get published. And then there are potential.
Cam, just any thoughts, Cam, on how you might be dealing with this at General Mills in terms of employee morale and hiring and retention?
Yeah, I mean, that's a tricky question, and that's why I'm not in HR. But I'll tell you, I mean, this ratio is going to get to some very serious questions about income inequality. And I'm not sure that any explanation from management is going to make it sound better to your average employee. I think the best you can do is remind employees, give them some perspective. Hey, did you know this ratio includes part-time and seasonal employees? So it's, you know, it's definitely a tilted ratio. And, you know, without addressing the ratio directly, remind employees of all the positive things that are associated with working with your company. I mean, you know, we've had tough times. I love working for our company, and there are a lot of reasons there, the people, the benefits, et cetera, that I think there's a story beyond the ratio that's going to flash across the headline over a series of days.
Right. There's also potential for this to become another data point in company decisions that it's not really intended to affect. Things like, you know, whether or not to undertake a new project through a joint venture that's not consolidated, where to locate a new facility or employees, things like that. As we start to see the kind of first wave of consequences from pay ratio disclosure, if the bad publicity is very difficult to deal with, well, companies are going to start to take that into account in making other decisions because it becomes a cost that management has to face. So again, how these will pan out is unclear. In some cases, it's easy to speculate, but almost every one of them seems to cut both ways. The next slide is just a kind of summary about best practices and things to do now. We're nearly out of time, so I want to move on and raise another, again, in the interesting, less obvious consequences. I'm sure we'll see more and more research come out on various constituencies that might be affected by pay ratio, but recently I was reading some interesting research about the effects on customers, and this is particularly going to be important in the retail arena or retail-facing companies, but research I was reading demonstrated that the customers were negatively affected in their buying decisions by what they considered an unfair pay ratio. Now, part of what was interesting about this is they were just given numbers. They weren't told the context. So there seemed to be kind of a natural difference between a company that had a ratio of 50 to 1 and one that had a ratio of 800 to 1, but that would affect buying decisions in a significant way. And so, you know, while we've all been focusing on shareholder impact and labor and employee impacts, you know, suddenly the question came up, and it was very interesting about, well, what about the impact on the customer base if we have a number that's wildly off? Again, everything cuts both ways, though, because there were situations in this research that I was reading that indicated that a low ratio was negatively effective, too, because people thought, well, that's probably not a very good company, or they're not very successful, or they're not focused on quality, or something's wrong with them.
Their CEO isn't very good.
That's right. So interesting and troubling and challenging. It'll be very interesting to see how the research continues to evolve in that area.
That's a whole new dimension. Thank you.
So finally, bear in mind the overlay, we're talking about disclosure here under the 34 Act for the most part, and 33 Act is effectively as well. So we have to keep Regulation FD and 10b-5 in mind. And so this circles back to what Jason mentioned earlier. I think it's going to be very important to put potentially more detail than people are used to in the past about some disclosures in it. By detail, I mean information that allows company to speak to challenges or questions that come up without saying, being quoted in the press as saying, well, there's a lot of important stuff that's not in our disclosure for you to be able to understand our pay ratio number. You don't want your executives quoted that way, because the SEC's getting pretty good about picking up on that and looking at Reg FD violations. So in order to be able to speak to why this number is unique to our company, you'll need to be able to have a fair amount of information in the disclosure about the unique characteristics of the company and the decisions you make. in order to support being able to respond to those questions as opposed to just saying no comment, which management sometimes gets uncomfortable doing.
And of course, great financial performance cures all ills.
That's right. And a good stock price, which
Good
aren't
stock
always
price.
related.
Well, we are out of time. Just in wrapping up, I want to thank you all for being here. We've given you some things to take away. Our thoughts, be proactive, start now. Hopefully you've gotten some helpful steps, some thoughts as to where you need to go next within your organization. We are obviously going to all be thinking about the ways that we can use alternative disclosures for ratios and extensive discussion of why a ratio is what it is as we go forward. So keep that in mind. I think that will be a big relief to some people within your organizations that you do have that flexibility. Just like the summary compensation table, many people want to do that differently, and some people do provide an alternative summary compensation table. We see this is definitely something that we'll be doing in tandem with the pay ratio rule. And then again, think in terms just beyond the application of the rules and calculation of the numbers. There are some obviously big picture questions here. We don't think that the CEO pay ratio should be overplayed, but we're realistic, and we know that just like the press goes to the proxy statement as soon as it's available and plucks out CEO compensation, that they will pluck out this ratio. So think about the effects beyond that to your shareholders, to your customers, to your internal employee base. Thank you all for coming. We will remain around for questions. If you have questions, please come forward. Again, thank you all for being here.